Well, welcome back to our last couple of afternoon sessions for this 2021 ACSI conference. I know that we've talked a lot about active ownership in the previous sessions, but of course it goes without saying, I'm going to say it anyway, that the priorities are not always the same and nor are the approaches. So this session looks at the challenges from the perspective of three levels of investor management: the chair, the CIO and the CEO, from three well-known super funds. Joining you for this session, Steve Bracks, the chair of CBUS, of course, he joins us from Melbourne. Damien Graham, who's in Sydney, the chief investment officer with Aware Super, and also Melbourne, Julie Lander, who's a chief executive officer with Care Super. So again, a big virtual welcome to our panel. Thank you very much for being there, and I'm sorry that we're not all here in person. I wasn't going to start this discussion by asking what keeps you awake at night, but just given the recent headlines around performance and the stellar investment performance by super funds in the last financial year, I did wonder, and Damien, I'm going to throw this to you, I did wonder whether expectations of a repeat performance are making you a bit nervous.
Thanks, Ali, and thanks for the opportunity to participate today. It's great to be there virtually. Look, I guess from my perspective, we're always trying to ensure members have reasonable expectations and a long-term view of what they need from their super or their retirement savings. So, we know 12 months ago we were having a very different conversation with very weak returns. So we've seen a very strong rebound and a strong return for members in the last financial year. But I do think that long-term view and making sure people attach to what they need on a long-term basis tries to ensure they don't have too high expectations after a strong year or too negative expectations after a weaker year, because both can be quite damaging.
How do you think COVID's changed the investment landscape?
Look, I think there's some things that have definitely been pulled forward a little bit. So if you look at some of the sectors that have really done very well, so there's been some structural changes, I guess, is what I'm highlighting. You could look at online retailing as a simple example where there's been a very strong pull forward of what was a long-term trend. And some people suggested 5 years of change has happened in a quarter last year with regard to online retailing and logistics. But I do think we're in a longer term period where rates are likely to stay low. And I think that means that there'll be a different way of creating economic growth. And I think that is a more medium term issue rather than just the shorter term cyclical issues we're seeing, and also the structural issue I just mentioned before.
Steve, what about from your perspective? We certainly heard in an earlier session about build back better. Do you actually see opportunities in the recovery? Oh, Steve, you're on mute. Great.
My apologies. Yes, Ali. Well, it's good to be with you today, virtually. And I think the different characteristics of this downturn are significant. It is proving to be a V recovery. That is, we're seeing a significant bounce back from flat returns 12 months ago to very, very high returns. And that's quite different to the global financial downturn, where most funds were in the negative for either 2007, 2008. And then we had that gradual uplift, if you like, the U return. So I think it's different. We haven't seen the depth of the downturn we thought we'd see in the pandemic. And we are seeing some opportunities, as we just heard from Damien as well. Some parts of the economy are going extremely well. For example, anything to do with leisure, a caravan, a bike, you just can't get them. There's supply issues. Retail, some parts of retail, are booming. Income is shifting, if you like. Our people are spending on different things that they otherwise would have. And so we've got the capacity, because of our broad spread of investment in a range of assets, to benefit really from that shift in consumer sentiment and the shift of where things are going. And I think most funds, because of the balanced nature of their portfolio and where we invest, will do pretty well in this period.
Julie, what about you? How has the pandemic affected Care Super?
Like most funds, it's affected us from a staffing perspective, and we've we've sort of achieved more change, I guess. You know, if you'd said that we're all going to be working from home, you know, 2 years ago, that would have been sort of a 2-year change management program. But we managed to all do that, you know, over a few days last year. So from an operational perspective, it's certainly changed. But in investment sense, I think our investment team has been very agile through the period. We believe in active management. It's certainly been interesting times and certainly offered opportunities to enhance that active management and show where it has its strengths. But of course, coupled with all of that, we've had so much legislative change. So, you know, to your earlier question about what keeps us up at night, I think it's about managing such levels of change.
Because that's one of the issues, isn't it, Julie, that you find you're so busy being reactive, it's hard to be innovative.
It is sometimes hard to be innovative when you've got so much on your plate, and also when there's so much uncertainty and you don't know where government legislation will land. So I think, you know, sometimes we sit back waiting for that legislation to come out so that we're not, I suppose, wasting time on things that might not come to fruition.
Steve, Julie just talked there about active management, which brings me to this sort of broader view of responsible investment. How do you think that's changed over the last 5 years? We heard from John Mullins from Telstra earlier today, who talked about having, you know, doing the rounds and finding that, you know, now some investors don't even talk price, they just talk ESG. But how do you think it's changed?
Well, look, it's changed enormously, really, and not just over the last 5 years, over the last 20 years. I think we started our journey of responsible investing, ESG, in 20 years ago, actually. And really, what's changed is that the world's changed. The companies we invest in now all expect that we will look at them in a prism of ESG. And that's been the enormous change that's happened right around the world. You know, we obviously invest, as we all do, all the three funds here. You know, we invest right around the world, and this change is happened largely. And so it's not that hard for us, really, to bring about change in responsible investing, because the companies we're investing in are expecting that is going to be the case. And I think all of us, you know, have a responsibility to ensure that we adhere to ESG, that we bring about change in the companies we invest in on all levels. And I think that's what we're doing.
When it comes to that process, is big better? How important is fund size?
Oh, big helps enormously. I mean, you need active management of a portfolio to interrogate on environmental, social and governance issues of the companies you're investing in. It's much harder if you're a small fund. You don't have the resources, you don't have the internal teams to do that interrogation. And so being bigger helps. It also helps to do it together. Yeah, that's across the investor landscape. All industry funds joining together to really bring about change in environmental, social and governance issues. You know, together we are large investors, not only domestically but internationally, and that can have an influence. So size does matter, and it's going to matter much more going forward as well.
Julie, do you agree you're at the other end of the scale to a point?
Yes, well, we're sort of approaching 20 billion, and we think that size, we invest for our size, and we also, I think, leverage our size to our advantage. And because we are also believers in active management, that really helps us integrate and implement our ESG goals, because we really engage with our managers and expect them to know the investee companies very, very well. You know, if you're big and if you perhaps use passive investment, you can use screens, but with an active approach, ensuring that your managers are asking the questions that they need to ask of investee companies and engaging with them is actually just all part of the process. So, I mean, we're certainly big enough to have the dedicated ESG specialist within the team, but our asset class specialists are also just, it's an everyday process that they would be asking the right questions of managers and engaging fully. So like Steve said, I don't think it's a huge shift. I mean, we are enhancing our ESG processes, but it's not something completely different that we have to start. It's an evolution.
And just before I bring Damien back in, Steve, I just want to ask you, that I get your point about big and having clout and that sort of thing, but the bigger you are, the more professionals you have to hire. Is it not harder to keep within the culture, stay true to the trustees' responsibilities?
Well, you're talking, Ellie, about nimbleness, I guess, and
also values and culture, because the bigger and more professional you are, the harder it's going to be, isn't it?
Well, not necessarily. Size enables you to bring in teams into your own organisation who can do the work otherwise you would employ managers to do. And that means that you can actually ensure that the culture of your organisation is kept largely, because you've got more control over that. And so I think it's been an easier journey from our point of view. We've now brought in, not dissimilar to Australian Super and a few other funds, about 40% of our investment capacity is now internal. International markets, domestic markets, small caps, property, they're all matters that we're able to interrogate and undertake within our fund. And that enables us to have the right culture in place more easily than it would be if we were just simply contracting managers to do that on our behalf. So I would argue actually the contrary. I think it's probably better and easier to maintain your culture effectively by having a size and capacity in which you can bring some of these things in-house.
Damien, what are your thoughts?
Yeah, I'd certainly echo the same feedback, Ali. I think from our perspective, we think that there's a great opportunity for us when we do more internally to have a much more streamlined and straight line approach to decision making. And that can be right across, whether it's the portfolio management aspects, whether it's a responsible investment aspects. So having a team internally that can really drive engagement with companies, actively look at the voting requirements, undertake research to ensure that we're thinking about the right issues when we're engaging with companies is absolutely critical. I was just reflecting on an experience I had many years ago, Ellie, just talking Steve's response to the changes in ESG, and I thought, I did talk to a portfolio manager probably a decade ago now, and I said, how would you break up 100% across ESG? And they said to me, it would be 90% governance, it'd be 9% environment, and it'd be 1% social. And I thought, gee, that's changed a lot in the last decade, because if you look at it now, what came out of the Royal Commission, the whole focus on ensuring that we're doing the right thing, not just the legal thing. There's such an elevated requirement and expectation of our members and society more broadly to do the right thing and to drive positive change. So I do think that has been a massive change in the last decade.
So how would you put it now? How would 100 go into ESG?
Well, I think the social side of things is massively increased. I mean, if it was from an investment perspective, it was seen to be the much more minor part of the considerations a decade ago or more. I think right now social is such an important issue, and for the right reasons too. It drives positive change. We know issues such as modern slavery are critical to get our heads around and make sure that we're managing those risks really well. So I think expectations across society have just changed materially in the last 5 years, particularly, but the last 10 and 15 years. So I do think that balance is much different. I think environment's clearly a significant issue compared to what it was as well, but not to say governance is not important, it is, but I do think it's a much more balanced approach across the ESG.
And I'll come back to climate, but Julie, can I ask you, what are the key issues that members raise with you? And is it a vigorous discussion? Are they very engaged?
Some are. I guess you can imagine there's a spectrum across the membership, some who are disengaged and some who are highly engaged. I think what we're really seeing now is that members want to see more than just what was the investment return. They really want to understand how you invest and what drives performance, not only just performance, but yeah, what are we invested in? So member expectations have certainly changed. I mean, they're seeing the results of maybe more E and S probably themselves personally, because they might be employees of companies, and they want to see that the companies that they're employed by or about or going to be employed by during their careers, they want to see that they're doing the right thing by employees. And equally on the E side of things, they're seeing floods or fires or water pollution or whatever, and feel a responsibility to drive a better planet for themselves and for their children or grandchildren. So we're certainly seeing a reality now. So I think it's been said before today that previously some of these concepts were a bit more theoretical in people's minds, but now they're so much more at the front of their mind because they can see the outcomes of perhaps, bad behaviour over the last few decades, and they want to do something about it. And superannuation is one of those things where they think that something can change and that we can drive change. So I definitely think we are seeing changing expectations.
Steve, with those changing expectations, and I have no doubt that you get the same level of communication with your members, I'm curious as to, from a management and an investment perspective, where you draw the line, I guess, between active and activist, between muscling in on what's traditionally corporate strategy and being a responsible investor. I mean, is that sometimes hard to work out just where you position yourselves?
No, it's not that hard. But if I just comment on Julie's comment as well, I think our members expect us to be responsible investors. Yeah, sure, there is some disengagement. Not everyone's an active member, but when we've polled our members, when we've talked to them, our members work in the construction industry, for example, they understand risk, and they understand that you have to adhere to risk long term to be responsible managers, and they would expect us to take action if one of the areas that we invest in is one of the companies we invest in is underpaying its workers, for example. They would expect us to take action, quite rightly, and we should. They'd expect us to take action if we were, building a building which was environmentally unsound and didn't adhere to the 5-star energy rating. Yes, of course they would. So I think I'd really sort of back up what Julie has said on that as well. Look, I don't think it's that hard, really, because we're acting in the best interest of our members by ensuring that the companies we invest in adhere to environmentally and sustainably and good governance principles, because we know that that is going to be a better performance for that company if they do, an outperformance, which is going to help us long term in the sustainability of that company. So really the prism on which we're determining this is really acting in the best interest of our members and what we believe is in the best interest. And so pursuing actively companies to ensure that they act effectively and with responsibility in ESG is really a part of giving a better return to our members. And that's what we're about.
And Damien, if we take climate as a particular example and a relatively clear-cut one, but if it's an easy ask regarding what you need to do to be a responsible investor, where does that sit in the conversation around engagement versus divestment?
Yeah, Ali, it's a fantastic question, because I do think when you say it's an easy question, I don't think it really is. Most of the funds, I'm sure Karen and also CBUS have committed to being net zero by 2050, which I know Aware Super we have as well. And I think that's a really important target. And so we've then got the target by 2030 to be about 45% less exposure or emissions from a carbon perspective. I think they're fantastically important targets, but the way to get there is not a straight line or is not as easy, and I think there's a lot of complexity to that. And so we know that we need to get doing things right now to really affect change. So I think when we think about divestment or engagement, we definitely prioritise engagement, and that goes to the fact that we do think, as an owner of most companies in the market, that we have a strong responsibility, to Steve's point, but also an opportunity to support the companies to progress and transition to a lower carbon future, and that's really important. We think that's an important part we play. We're the lead investor for a few of the largest emitters in Australia in the Climate Action 100 plus, and we're really trying to work with those companies to help understand how they're transitioning. But we also did make the decision late last year to divest from thermal coal producers, and that wasn't an easy decision. But again, to Steve's point, the way that we think about that decision is very much an investment decision. It's not an ideological decision. It's, do we think that from a member's best interest perspective, does that reduce the risk of long-term returns to members? And the board made that decision, that it was the right decision to make, and decision to divest. But not done lightly, because you do lose the opportunity to engage with those companies, and that's something that we don't take lightly either.
Yeah, that's right, isn't it? It's a saying that if all the responsible investors sell out, who's left? It's by its very nature the irresponsible investors who are not the ones that you want to be owning these assets. And I guess, Damien, do you think that your members broadly understand that, and that they understand that you might need to hold something that is a little bit unappetising on the ESG front in order to try and help the transition?
Yeah, so I think that's right, Ali. We do get, like the other funds, a lot of feedback from our members, million or so members, and we do have good amounts of feedback on climate. It's probably the most regular conversation we have with members is around, from the ESG perspective, around climate issues. So that's the top of the list from our perspective. We definitely think that our communication's been as active as it should be and can be around how we're managing climate transition. We updated our climate transition plan early last year, and we're very set some aggressive targets and some key targets we thought would drive us towards those goals. And we tried to ensure that we communicated that broadly to our membership so they understand. And we've had very positive feedback around that plan. So we think not all members are engaged. I think that's common across all funds, but certainly we've felt that the ones that are focused on the environment and climate have given us great feedback around how we're trying to approach it.
Julie, Care Super, of course, is not there yet on zero by 2050. Why not? And can we assume that you will get there?
Yes, let's just say, we're working on it very, very fast, and I'm sure you'll hear something soon. But another thing that Care Super did was get carbon neutral accreditation through the government's Climate Active initiative. So we wanted our commitment to be not just about investments, that's hugely important, but to emphasise to our members that as an operation, as an organisation, we are committed to being carbon neutral as well in an operational sense. So we've had that for 3 years, I think. We were one of the first funds to do that, and that was a significant commitment that we've made.
And do your members understand that divestment versus engagement conversation and the need to be in there to win, if you like?
Yeah, look, I think maybe some do. The challenge is probably that as investors, we're wanting the economy, or we're wanting to transform investments at a faster pace than reality. And so therefore, sometimes we have to be a bit patient and perhaps educate our members that it's not just a line in the sand divestment that is not always, that's not practicable. So, it's sometimes about managing people's expectations about sort of the journey.
Steve, do you agree? So also a question of managing expectations?
Yes, and I think generally that we all want to ensure that engagement is the key principle on which we operate going forward to bring about change and to get companies to adhere to the climate targets, to more social and governance arrangements. But, you know, to reflect on what Damien has said about thermal coal, there are occasions on which, in acting in the best interest of your members, you don't want to have an investment in a stranded asset. Like, it's very likely that, well, it's going to be almost impossible to see how investors would want to invest in a new coal-fired power station. The returns won't be there. It's likely to be a stranded asset. It's an asset that won't be there for the long term. And so they're legitimate decisions you make from time to time on divestment if you believe that the return is not going to be there, it's irredeemable. And therefore moving out of it is a positive step. But generally, I think engagement is the key issue from that point of view. And I think that's proved to be quite successful. For example, we've got some real live examples, all of us largely. If you look at Rio Tinto, and of course, Guggen George, the board management changes and commitments to improve management with the First Peoples has happened. We've seen the chair and the CEO of Rio Tinto go. AMP, when they tried to promote Bio Pirani to the CEO of AMP Capital, despite having settled a sexual harassment claim, the chair of AMP eventually resigned, the CEO of AMP resigned. And we've had a more recent one, of course, with Woolworths in Darwin, discontinuing its Dan Murphy's investment because of lack of consultation that occurred more generally. And that's largely brought about because of engagement, because as investors, we've really engaged with those companies and said, you really need to change. You really need to consider the impact of what you've done and bring about some change. And each of those occasions, you've seen that happen.
And indeed, the need for better engagement with First Peoples is the subject of our next panel. But I wonder, John, we heard earlier from a little bit of concern from Catherine Livingston at CBA, just about how patient investors will be. And it's not on really clear-cut instances, and stranded assets are obviously, a separate issue, but more about, okay, we're going to have to cut dividends while we reconfigure our profits. It's not going to be a smooth trajectory necessarily, full of opportunities to get to net zero. Do you think your members understand that and are prepared for a dip in returns for a brighter future?
I don't think there will be a dip in returns. I believe the climate has changed. The environment has changed enormously worldwide. You've got something like 70% of the world economy now is committed to net zero by 2050. The EU, UK. China is moving to it in 2060. The US looks like it's moving that way as well. And so really, this is the climate on which, as investors, we're in. And so I don't think it's unrealistic. In fact, I think the contrary. I think we're going to find that if we don't commit to proper targets on climate change and adhere to our investments on that basis, well, I think we'll be in trouble, actually, and I think we'll get lesser returns as a result if we don't do it.
Damien, that brings me nicely to a question from Ashley Kopsinski here. We can have our cake and eat it too, i.e. invest in a socially responsible way along with outperformance. How can we better educate members and broader society that you don't need to sacrifice returns to have a positive impact investment portfolio? Give that to you, Damien.
Thanks. I think that's a great segue, Ali, because I know we've talked a lot about managing the ESG risks around climate, and definitely that's an important part, as we've touched on. I do think there's a whole lens of opportunities that it opens up, though, because we certainly believe that there's, allocating more to businesses and assets that will benefit from the transition is a great opportunity. And I'm sure the other funds are doing that as well. So I do think that lens of making sure you're reducing the negative impact and amplifying the positive impact in your portfolio is a great lens to have. We think there's a great opportunity to drive long-term returns by doing that. It may be in technologies that benefit, it may be in renewable energy, maybe in battery storage. There's all sorts of different opportunities you can really seek out. And I do think it allows us then to create better return outcomes in that broader impact perspective. But we also think one of the points I was going to make just on that aspect is we've thought a lot about it internally, that what we'd like to see is our broader portfolio, it's $150 billion or so, to really reflect the ESG and the impact side of things as broadly as possible. So it's not just one small part of our portfolio, it's not just the socially responsible investment option, but it's really the $150 billion that reflects that aspect of good reduction of the negative impact, but obviously amplifying the positive as well. And I think it's a great long-term opportunity for us.
How much harder is that for you, Damien, when it comes to your private assets as opposed to publicly listed companies?
Well, I think it's a really good point, because one of the focuses with our climate change portfolio transition plan was to reduce the carbon footprint of our listed portfolio, and we wanted to target a 30% reduction in the first 3 years. We've pleasingly already met that, and we're about 40% lower in the first 12 months. So it's been a good start to reduce the carbon footprint. But that's not additive. When you think about the additionality of what we do, we think we can make more additional changes through the private portfolio, whereby if we own an operating business or we own an asset, if we can reduce the footprint of that, it actually reduces the global footprint rather than just selling that listed share to somebody else. So I think the private side is much harder. It's much more complex. I think Steve's touched on it well with property as a simple example, where if you own a property directly, you can have a strong influence on how that property is built, obviously how it's maintained, its energy usage, its refurbishment, etc. So I do think the private part of the portfolio gives you different styles of opportunities, but it is much harder to do.
Julie, can you give me some insight into what it means for you in trying to, I won't say reach net zero, I'll just say reduce carbon across your entire portfolio?
Was that for me?
Yes, just how challenging it is.
Well, I think, Damien sort of touched on it as well. It's not without its challenges, but, and you have to start measuring things and set some goals and, really understand where you need to target first, I suppose, to make the biggest impact. So, it's not without its complexities, but I think we're all sort of learning from each other too, and I think that's one of the strengths of Industry Super, where we can share some of our experiences and share our approaches. And there are actually lots of good things that we can invest in as well, as Damien just said. So we've got the risk side, but we've got the opportunity side.
Another question here from the audience. So I'll put this to you, John. Responsible investors don't invest in irresponsible companies. When are the super funds actually going to exit those companies that are not doing the right thing? Engagement only gets one so far. They're saying beyond the coal, tobacco exclusions. Well, I suppose you've sort of stranded assets are again and sort of another part of this. At what point do you call it? At what point do you say engagement's not working?
This is to me.
Yeah.
Yep. Well, we have made decisions, I think, on the basis of excluding some categories of investment. For example, we're one of the funds who does not, we divested in tobacco. We don't invest in any tobacco industry. We don't invest in any armaments. We haven't gone to the extent, I think, that we've, in relation to all coal, but obviously very unlikely we're investing in any new coal investments. So I think it's really a balance. It's a matter of assessing how you best can achieve the goal of achieving zero emissions by 2050, and part of that will be by engagement, part of that will be by divestment. But the reality is that every other company is moving in this direction anyway. So I don't think it's going to be that hard to achieve.
Damien, can I give you this question? Has the recent change of a super fund's obligation to act in members' best interest to the more explicit members' best financial interest, does that make a difference to how you approach active ownership? I'm guessing you're going to say no, but...
No, I think it goes back to the point we talked on earlier, Ali, which is really about the fact that we think managing ESG risk is simply a smart thing to do financially and from an investment perspective. So it's not a hard one I don't think the trustees are too challenged by that. Again, Steve as a trustee on the panel, I'm sure you'd support that. But you know, our trustees aren't challenged by that. I think it's very clear that if we're managing ESG risks well, then we do expect that there'll be a benefit to members by better long-term returns, and it's a fairly simple equation.
And here's another question which I'd like to give to both Damien and Steve. It's actually a really great question. How did CBUS and Aware boards get comfortable with net zero commitments? Might sound like a strange question, but it's actually not. I mean, if you're so comfortable, Damien, why didn't you do it ages ago? You know, what was the tipping point?
Well, and from our perspective, it was certainly part of that portfolio transition plan that we put together. So we've had over the last 6 or 7 years a number of certainly an initial plan to transition the portfolio, and then we refreshed that early last year, and we felt that was the right thing to include into that planning. So that was when our commitment was made. But I don't have a great answer to say it should have been a year before or it should be now. That was obviously part of the review, and that updated targeting was part of that review's outcome.
Steve, how did your board get comfortable?
And probably not dissimilar. Our first climate roadmap was about 3 years ago in 2018. And in that, we already had one of our major property managers, CBUS Property, which we own, we're a direct developer. We'd already had a 6-star energy rating portfolio because the companies that were renting properties on long-term leases from CBUS Property wanted those sort of buildings. And so we'd already achieved that through one of our key managers, CBUS Property. And so we moved in 2020 to, through modelling, through looking at what we think we could achieve to a firmer target of zero emissions by 2050 and a 45% reduction in emissions by 2030. We believe we can achieve that. All the modelling shows that that's going to be the case. As I mentioned before, we've got to remember that 70% of the world economy is already committed to the same thing. So, we're in tandem, really, with what's happening around the world. And largely in Australia, we're an outlier in Australia, largely because the government is really not adhered to a hard target. I can't remember what the Prime Minister's target is, a possible or probable or some definition. But, they're going to be dragged in it. Industry's going to drag them in. Investors are going to drag them in. They're following, not leading. And largely, I think, we believe this is where the world is going, and we believe we can, in looking at some of the modelling, we can get there.
And Julie, the sorts of conversations, the sorts of research, I guess, that you just heard about from Steve and Damien and what was happening, is that the sort of thing that you're now doing inside your organisation?
Yes, certainly, yeah. There's a lot of work being done. Obviously, not sure.
I do want to just ask you, we're going to run out of time again, as we always do, but the issue of proxy advisors, which I think is, Julie, you brought it up before because it's particularly pertinent, when you're a smaller fund and you rely on some of that external assistance. How would you rank the influence of proxy advisors in your decision-making process, and what are your thoughts on the government's proposed changes to how they operate?
Well, I think they're one source of information for us, an important source, and we value it. But as I said before, we believe in active management. We absolutely insist that our managers engage with companies as well. So we will see what the proxy advisors say, what the managers are saying. If there's a disconnect, that's when we will really look into a particular issue. But I think proxy advisors have a very real role to play, but they're not the only source of information that we take. And people should not think that funds just, it's not a ticker box system and we just get in this list from the proxy advisors and vote that way. There's a lot more thought put into it.
Damien, how often would you go against a piece of proxy advice?
Look, we certainly vote all our proxies, but we don't go against them that often, Ali. We do, but we don't. It's not a high proportion of the votes. But again, to Julie's point before, certainly what we do is we take that as one input. we do the analysis ourselves internally. We've got a team that does that. We talk to the managers, we talk to the company quite often, and we'll already be doing engagement with the company anyway. So it's part of the decision making. But we do, I think the point that we made, just responding to the government's proposed approach, was just the likely increase in cost. If we were having to do this process all internally by funds, it would just have a very material increase to the cost of voting, and we need to do that because our members expect us to be good custodians of their money, so we can't avoid voting, but to do it all ourselves would be incredibly expensive.
Yeah, it's far more efficient, I think, to use proxy firms. It's efficient for the companies and it's efficient for the funds.
And especially that was the point that was made earlier sessions, Julie, about just how we tend to have all these resolutions and AGMs all at the same time. So it becomes unrealistic for individual contact. Can I just ask you, Julie, this is a final question on the proxy issue. Do you think that companies should be given 5 days to respond to proxy advice before it's sent out? Are you in favour of that?
No, I don't think I am entirely. It's a complex issue, but I mean, they've got the opportunity to send out information to their shareholders. The proxy advisors, I'm not at all making any excuses if they've based their advice on incorrect information. They have a responsibility to get it right, but I don't necessarily think that they need to provide the companies with 5 days notice. I mean, the proxy advisors act on behalf of the shareholders, not of the companies, that are company management.
I just want to use the few minutes that we've got left to have a look at future challenges. And Steve, particularly because you finish in the chair's role at the end of the year and you've been a director for 12 years, when you look back, and bearing in mind we only have a few minutes because it's been a long career, but what's been the biggest challenge and what do you think is the biggest challenge that you're leaving for your successor?
Well, I think the change has been enormous over the last 12 years that I've been a chair of a super fund. We've seen a significant shifting of in the landscape. For example, when I started, retail funds, which were all largely owned by banks, except AMP as a mutual, the rest of the banks all had wealth management arms, which they bought, Colonial First State and others. They were a bigger sector when I started of the superannuation industry and industry funds. The reverse has happened. Industry funds have now a larger sector of the funds under management in relation to super funds. The banks are in retreat. They're selling off, getting rid of all their wealth management arms. What they thought were rivers of gold has been a real problem for them. They got skewered in the Hayne Royal Commission. That was an enormous change, and we've seen a significant flow of members' money coming into industry super funds as a result. I think that's been a big change. Secondly, consolidation. I think we've all talked about this, and over the last 12 years I've been involved, there's always been talk every year about consolidations, mergers, less funds, but it's actually happening now. And I think the landscape, if you look at the future, that's the challenge for the future. But I think APRA are right, you probably need to be at least $30 billion funds under management to be an effective fund in relation to unit costs, the cost of servicing your members, and also how you can maximise returns. I think that's where it's going. The MySuper changes have really reinforced that. The heat map has reinforced that. And I think we're going to see a completely changed landscape over the next few years with fewer funds and bigger funds as a result. And I think the other key issue is just the increased regulation that's occurred over the last 12 years. A lot of it not necessary, but a significant amount of regulation, and that's it's almost as if they believe that super funds are the sins of banks, which occurred, as we saw revealed in the Hayne Royal Commission, have been transferred onto funds because it's really caused more regulation as a result of our industry as a result of that. And I think that's been a disappointment. And I guess the last one is that it shows you how strong industry funds are. They have outperformed. We do give better returns to our members. They are supported by our members. And so every attempt by the current government and its predecessors to try and neuter industry funds has been unsuccessful. Why? Because members like it, because we're performing well and we're returning well. And I believe that is going to be the case in the future as well. They'll keep trying. They'll keep trying on behalf of their mates in the banks and others to get rid of us, but they will not be successful because we have a strong support from our members and we return extremely well. And so long as we keep that, I think we'll be okay.
Thank you, Steve. And Julie and Damien, we are out of time really, but I promise I'll give you longer when you're retiring. I just want to very quickly get a comment from you. Julie, quickly, do you think, in fact, size, the changing landscape in terms of mergers is really going to be one of the key issues in the future? Yes.
I mean, it is that we are seeing a change in the structure of the industry. So, yes, it is a factor, and just this level of change, the level of regulatory change is clearly a factor as well, because I mean, you really do need to be of a certain size to be able to manage that change. So, I don't think that one size fits all, and I do think that there is a place for smaller and larger funds, different investment strategies, different servicing models. So I actually don't think that we need just funds of a certain size. I think there's a very real value proposition from some smaller funds, medium-sized, whatever. But you need to be of a certain size. Otherwise, it's just getting way too hard. Damien, can I ask you for a quick final comment?
Yeah, I mean, we certainly ascribe to the comments on consolidation, Ali. We've been, I guess, participating in that in the last few years with a couple of mergers last year with Vic Super and WA Super. And we do think that it's a likely trend that continues in the next few years. And I think the government's trying to change the way that we all operate and become far more choice-led. So I think that's just going to lead to additional consolidation, I would think. And we do think that there's a natural way for larger funds to continue to grow organically and also inorganically. So that's our view.
It will be a many and varied landscape, no doubt, in the coming years, but lots more change to come, it would appear. A huge thank you to all of you, to Steve Bracks, to Damien Graham and to Julie Lander. Thank you so much for joining us this afternoon.